Hello, ladies and gentlemen. It's Modern Investing with Sasha. My name is Sasha Starr, and I would like to introduce my panel for today. There are esteemed guests, starting with Peter Bennett, the former professional from Wall Street. Dr. Milan Samborg is our new regular author of the book, How to Beat Wall Street at Its Own Game. And finally, the founder of the network, Nick Palidiva. Welcome to the show, everybody. And,
Thanks, Sasha.
Hi, everybody. And I would like to start with Peter. Could you please give us the latest update on the news on the market? What's happening, so we will all be on the same wave?
Sure. As my new expression is, all the financial news you need to know. And so I'm going to be giving summaries as I have to a point before. There's so much news in the news. It really comes down to the big questions. What's the Fed going to do? What's energy going to do? And are we heading into recession? These are the big three questions, which at the end of my news review, I'll ask the panel. What does everybody think? Because these are the questions the market is wrestling with. The Fed itself was talking less hawkishly. And I understand why, because they are between a rock and a hard place. They don't want to cause a recession, and they want to control inflation, which I personally don't believe they can do. I think it's going to be recession myself. But Morgan Stanley, by the way, said they expect a 20% further decline in the market, or a good possibility of that. Ed Yardeni, who's a well-known financial analyst, predicts that what's going to happen is price inflation is going to come down to maybe 4.5%, and then the Fed will adjust their inflation targets to 4%. And I thought that was brilliant, because I think that's what might happen. The Fed, I don't think the Fed has a chance to bring down inflation without crushing the markets and the economy. So I think they're going to have to compromise by saying, okay, we're going to accept more inflation than we've used to. And they'll probably say, well, we had less inflation for a long time, so it'll all even out, which is kind of the reason they didn't increase, by the way, their rates earlier when they faced inflation, but they didn't expect this. Janet Yellen did admit she was wrong about inflation. The Bain & Company CEO said recession is a natural part of the economic cycle. Elon Musk predicted something else. He said long-term deflation, which I also agree with in the long term. And he said because of AI and robotics. And I think that's, in the long run, going to cause a lot of deflation. So personally, I think we're in for whipsaw, where energy and a lot of inflation issues rise for a few years, and then we're going to hit deflation, which that would be a separate show. Robotic sales increased 40% year over year. So companies are going out and saying, replace my labor with robotics, which is good in the short run, helping to hold down inflation. In the long run, it may cause deflation. The U.S. savings rate dropped to 4.4%. That's the lowest rate since 2008. Credit card debt is going up and up. People are struggling with inflation, basically, and trying to maintain their lifestyle. Inflation, though, in April came in at 8.3%, barely less than the 8.5%. Gas prices hit a new high over the weekend, and we're just heading into a driving season now. And GDP, by the way, for the last quarter was down 1.5%. So this is an article I just saw today in the New York Post. Fueling summer fears, the United States and Europe could experience fuel shortages this summer that could be worse than the 1970s oil crisis. This is coming from the International Energy Association, International Energy Agency. He said back then it was just about oil. Now we have an oil crisis, a gas crisis, and an electricity crisis simultaneously. Gas crisis because natural gas is going through the roof. It's more than doubled by far, and there's shortages. And they're talking about possible blackouts this summer in the United States, which won't be, that won't necessarily hurt the economy, but people aren't going to be happy with that. Europe just agreed in the last few days to cut 90% of Russian oil imports over the next 6 months. And they get 25% of their oil from Russia, and as well as 40% of their natural gas. To top that, I read that office occupancy right now in the United States, not the vacancy rate, the occupancy rate, just came in at 43%, and in New York City, 39%. This I've always felt could be a black swan that's coming because they're going to have a lot of vacancies, but it'll be a rolling thing as leases come up. But this could hurt things for a while. So the question and finally, I'll get to the questions for the panel, which is, and I heard an analyst today say that in a non-recession, the average correction is about 20% where we were last week. But in a recession, obviously, it could be a lot more. So the questions are we heading for recession or not? Is inflation under control or not? And what will the Fed do, to control these?
Nick, would you like to start?
Sure. Okay. The thing is, here's the way I see it. First of all, we're in a recession, so it doesn't matter whether you think you're in a recession or not. We're in a recession because the market is off 20% from its high back in January 3rd, 2022. Problem number one. Problem number two, how long is this going to last? The data that I get shows you're looking till October before we start climbing out of the recession. And who is this data coming from? The data is coming from the people that control the market, which is none of the four people here. It's from, as Peter knows, the big investment firms on Wall Street. You can't go against BlackRock and Goldman Sachs. If they all say it's a recession, it's going to be a recession. They say it's going to last 6 months. You know this, Peter. It's going to last 6 months. So it's going to last until October. Now the real question is, what do you do as an individual investor? Do you want to stay for the 20% ride down on the elevator, or do you want to wait till October and then catch the elevator back on the way up? So I'm looking, or you do something in between. That's one reason I like what Peter suggested is the dividend stocks and the oil and gas industry, which is where I'm sitting at, and it's doing quite well. So that's
excellent. First of all, let me address, Milan, before I'll get to you. First of all, let me address for our listeners the definitions. What's the difference between recession and depression? Recession is when your neighbor is out of job, and depression is when you are out of job. So if there is a recession, it means our neighbors are out of jobs. We still have the jobs. What we have to do is navigate financial markets, and out of trillions of dollars daily changing hands, all we want to do is to get a few $1,000s here and there. So if you make, say, 10, 20,000 a month, that's okay. You can survive with this money. And if you can make even more money, it's even better. So later on in the program, I'll address that, how we can mitigate this and achieve it. However, there is a very interesting thing about your book, Milan, about 6 habits of the Monday morning millionaires. Maybe that will help people to concentrate their efforts and not get lost in all these discussions about recession and depression and inflation and all this doom and gloom what there is on the market, obviously, right now.
Well, I'll start out by asking you a question. Have you ever made an investment mistake? Do you know anybody who has not made an investment mistake? And I can tell you that every investment mistake that was ever made by any investor, or that will be made by any investor in the future, will arise from ignoring one or more of the 6 habits of Monday morning millionaires. I may mention before that many of our members are either close to retirement or retired, and many of them make on a Monday morning before breakfast more money than they ever did during their best week at work by following the 6 habits that we talk about. Any mistake anybody ever made comes from ignoring one of these 6 habits. And the 6 habits are: number 1, save. Without number 1, nothing else matters. Number 2, do it yourself. We need advisors for wills and for incorporation and for a whole lot of things. And generally, these advisors save us more than their fees, which start at $300 an hour, if not more. So we need advisors in all those areas, but not for investing. We can teach a high school student how to equal the American market in 15 minutes. And the American market has produced 10% annually, not inflation adjusted, for about 200 years now. Will it do so next week, next month, next year, next decade, in the future? Yeah. So habit number 1 is save. Number 2 is do it yourself. Habit number 3 is invest in the American market by buying an exchange traded fund which tracks the S&P 500. The S&P 500 itself is a very excellent approximation of the American market. Habit number 4 is buy and hold. No trading. Wall Street wants you to trade. That's how they make their money. Huge conflict of interest between you and me and Wall Street. So no trading. Habit number 5 is rebalance to your asset allocation, which should have a very large proportion of money. Say a 50-50 asset allocation works for a lot of investors, where you have 50% of your money in the American market, as shown by the S&P 500. So you take an exchange traded fund which tracks it. SPY is a great example. And so rebalance whenever that asset allocation is thrown off by market movement up or down. And habit number 6 is, if you cannot explain an investment to a 10-year-old, a 12-year-old, don't get into it. Avoid complexity. So if we adhere to these 6 habits, we will earn, very likely, as we have in the past, about 6.5% inflation adjusted, or 10% not inflation adjusted. It's as simple as that. There's not much to talk about. And so
Well, the interesting thing is that it's not the first time that I'm listening to your presentation. And every time when I hear that, I think this it is. This is the essence of investment. This is what I'd like to do. Well, I'm doing similar thing with my core portfolio, except that I'm somewhat there is more allocated to high yielding dividend stocks, but that's only because I'm a greedy person. Otherwise, I would just follow your strategy 100%, and probably I will. Nick, I would like to ask you about your trading experience in the last week or so. What's interesting that you bought, sold, or thinking about buying or selling?
Well, actually, Sasha, I held my positions, but it's like, the way I look at it, it's more like a game. It's like a chess game. Okay. Then you have your position. Are you going to hold your position, improve it, et cetera? But what I did, and I checked my portfolio mainly in these energy stocks that Peter's recommended: Antero Midstream, hold; Enbridge, hold; MPLX, hold; U.S. Compression Partners, hold. Then I got a couple of them that are fun. I call it fun stocks: Net Capital and Alibaba. And Alibaba was kind of like a ride up and a ride back down. And I just decided to hold it because I was China really going to let this stock collapse? But all of them are doing well because back to the theory, you get a big dividend on all these stocks, all the energy stocks I'm talking about. Okay, these momentum stocks like Alibaba and Net Capital, but the dividend stocks, I go, hey, look, if somebody gives you, let's say I got 0 from it, but I got a 7 to 12% dividend. They used to have these, these coupon bonds. I go, hey, look, I'm okay with it. 7 to 12%, and I don't have to do anything. I don't have to think. The problem is, Sasha, all those investments that Peter, Milan, and you talk about are boring. That's the bad thing. Here's the good news. It's print. These are businesses that print money. And I like businesses that print money, Sasha. And so I'm sticking with that program.
Absolutely. And as far as this is why in my portfolio, I keep the high yielding dividend stocks. I keep in separate account so they don't support by margin or otherwise my fund account. And the fund account, I have the joy of using options. For example, if you take your stock Alibaba, which you like, Nick, obviously, right? I would never purchase a stock right away. What I would do, I would sell puts, which would, in certain scenarios, allow me to simply, most of the scenarios, I would simply keep the premium. So let's see if I sold puts worth, say, $6,000. So let's see your portfolio, your fund portfolio is worth, say, $50,000. So if you sold for $5,000 some puts, you keep the position, they are expiring worthless, as is happening with most of the options, whether they're puts or calls. So now you have in your portfolio, without doing much, instead of $5,000, you have $5,500. It's not hard work either. That reminds me, basically, what are you selling? Why somebody is buying from you these puts? It's like, let's say you're coming to a market, a real market, like a bazaar, okay, in Europe. Okay, you're coming to the market, and you have a stand, and you have a sign. I'm selling time. So there are a lineup of people, they want to buy time from you. How much you going to charge? You say, okay, let's start with $6,000. So somebody says, 6,000, it's too much. I'm willing to pay $5,000 for your time. Okay, $5,000. Okay, here is your time, and here's my $5,000. We made a transaction, and he's very happy because he bought time. So he now play with the time. Now the time, as you know, is going on a certain way that it's let position most cases expire. However, in some cases you can be exercised. So that means that you will in fact purchase Alibaba shares, but at much lower price. Because you keep the premium, the price, let's see, Alibaba is trading, I don't remember, probably $90 today or something. Okay, and let's see if you sold same 90 puts and you got, say, $5 premium. That means that you will be exercised and you purchase your stock at $85, but you got premium of $5 already. So you're ahead of the game. Now, let me suggest something else. You know that American-style options, which we are all trading daily today in the United States at least, you can close your position anytime before the expiration. So let's see, you sold for $5,000 worth, and slowly with time, let's see, it's a choppy trading back and forth or so on. So the time will start, that position, it will start deteriorate financially. So let's see, you sold it for $5,000 and see a month later, you can close your position, say for $4,000. In this case, you simply got $1,000 profit on your account. You don't have stock, but you never had it anyway, and you just go on with your life. Now, what's happened if you will, in fact, get exercised and you got Alibaba stock? So it's happened, let's say, on Friday, certain months, and coming Monday, you now have a position of, say, 1,000 shares of Alibaba. Great. You immediately sell next or a week over covered calls you now sell. Again, you're on a bazaar, you have a sign, I'm selling time, line up of people, they're buying from you this time, and you're selling them. Let's see, if you got Alibaba on your price, let's see, $85, so it sells them 95, say, August or September calls. So they're buying, they're paying you money, and if the stock will continue choppy trading and it will close less than $95, you keep the premium, your stock went up in price, so you're making money on the stock and on the options. So comes exercise of the options, they're expiring, hopefully worthless. and you sell next, say October calls. Say maybe stock is 90, 92. You already sell, instead of 95, you sell 100 or maybe even 105 October, for example, calls. So this way, you're making money first on selling puts. Once you acquired stock, if you acquire stock, it's not a done thing, but let's say if. Now, the danger is what's happened if you sell puts, let's see, and the stock went down so much that you got exercise and stock continued to go down. And this is one of the scenarios. It's like in chess game. Let's say you are making a move and you have to anticipate one, two, maybe three, or sometimes more replies of your opponent. You have to already have a game plan, what to do in this case, in other case, and then in the third case. One way to make money, if you will sell, let's say same Alibaba, $90 stock, but you can sell, say, $60 puts. They're very cheap. You will not get a lot of money for the 60 puts. You will get, I don't know, pennies, maybe 15 cents probably. I can look up how much they are, but trust me, they're not very valuable. But what are the chances for Alibaba go down to $60 in the next 6 months? I think there are much more chances for Russians to take Odessa or for Putin to die than for Alibaba going down to $60.
Sure, I agree.
What's your opinion?
Sasha, what time frame are the puts you're selling? First of all, are you selling like a week put or a month put? What time frame do you like to
Exactly, very
sell?
good question, Peter. The most how to say bang for your money, obviously you get the shorter the distance in between when you're selling and the exercise price. So when you're selling weekly puts, you will get in percentages most of the money and most of the bang for
But what
your
do you do usually? Because I know
What
you've
I
been very
do,
successful with options.
I don't have a rule. It depends on the stock. Each stock has its own characteristics. You have to study trading pattern of each stock because each stock has specialists, money makers. They're trading certain pattern. You're already learning when you concentrate your
So what range? What range do you usually? What's the shortest you do a week, and the longest is what?
The shortest is a week. The longest is sometimes I go as far as almost a year, like 9 months.
Wow.
But you know what? It's not very good idea to sell such far options because first of all, you're doing that in your fund portfolio. What kind of fund you have sitting for 9 months in one position? Probably not much. Also the decline normally happens really like a time decay. It's happened in the last months and a half. So for 8 months, you're sitting there with not so much action really going on. Number two is that you get, if the shortest time expiration, you have the most bang for your money. So the farthest month, you have less bang for your money, right? So the only thing I would consider to sell 9 months, for example, expiration time, if I would do, for example, the straddle type of trading, when I would sell, for example, Alibaba, say 75 put, and I would buy also the different months of expiration, I would buy, for example, 70 put, for example. So if I would do spreads and other ideas, I could do this calendar spreads or so on. But for the beginning, I wouldn't recommend people to do spreads and so on. It's a little bit more complicated. You have to first understand selling, number one, never buying, always selling.
Well, it is a way to protect yourself, though, Sasha.
Yeah, you
right?
protect yourself on the downside.
What if you're because if you do a spread,
Yeah.
I personally think spreads are a better way to control risk. I mean, and also I've heard, but I don't know. I tend to sell very long-term options on stocks that I like a lot. And right now, basically just hold, doing it to hold a few stocks that I want. But you know, if you sell and you don't have any coverage, you could get hammered, in the short run. Now, in the long run, you're the casino, like you're saying. So that if you're selling the options, you're at an advantage. Also, I've heard that time value tends to decrease very quickly in 30 to 60 days or a week. So if you go longer than that, you're not getting that advantage. But if you have 30 to 60 days, but in a way, I view it almost also as income, because theoretically, even if the stock goes down, if you sold the call, as long
Well,
as you don't
first of
get
all,
hammered again. If you get
exactly.
hammered by having
Exactly. The
no,
point is, you don't have to wait until expiration. You can first of
Right.
all close your position, get your profit, get out. Please, Milan.
but if you start losing,
I'd like to make a couple of comments. First of all, selling, only sell, never buy. Do so in your fund portfolio, not in your core portfolio. And selling covered calls, if they are paying a dividend while you own them, you're going to collect that dividend. Doesn't happen if you have cash secured puts. In cash secured puts, you never own the security, so you never collect that dividend. If you're selling covered calls, yes, you collect the dividend if you happen to hold the stock at the time of dividend payout. So that's a big advantage. The other
Milan,
one is in tax advantaged portfolios, selling cash secured puts is not permitted in Canada, but it is in the United States. It doesn't make any sense because the risk is the same. Covered calls or cash secured puts, same risk. And don't expect governments to make sense, but Canadians are not allowed to sell cash secured puts in their tax advantage portfolios.
in tax advantage, but in your trading portfolio, it's allowed. I would like to mention one thing. What you said about dividends, that's happened to me just a few months ago. I had a CIBC, Canadian Imperial Bank of Commerce stock. They were paying dividends about 5.5%. I held it for some time and selling covered calls, and everything worked out great, except next Friday I was already was collecting dividends. And guess what? On Thursday, I was assigned. I made money on calls and on stock. I am not complaining, but my little dividend, which was coming Friday, was taken away from me because somebody wanted to grab that dividend and got exercised, and I was out of the position.
Well, then I'll raise the question I raised at the end of the news. Sasha, to you even, what if you're selling unprotected puts?
That's the problem.
And the market goes down? I mean, are you assuming the market isn't going down? Because, there's some who are saying the market's about to head down 20%. Is this the time to do that? Or do you think we're not heading into the market won't go down 20%? Or you don't know?
You're selling unprotected put only on those stocks that you would like to buy anyway.
Okay.
And you would buy. Let's see, Alibaba is $90. I come to Nick, say, Nick, would you like to buy a stock from me for $87? It's trading at 90 right now.
Yeah, of course.
Well, you would grab me and say, give me my stock right away. Okay, so here is, if I'm willing to buy for $87, and let's see, in one of the scenarios I've discussed, you're selling 60 put, which will allow somebody to sell you that stock at $60. You were willing to pay $87 just
right. So it's a win-win, you're saying, basically, because
so what I'm saying
either you make money on the put, or you
wait. What I'm saying is that I'm selling put only on the stocks that I'm willing to buy anyway. So if that happens, that I will be exercised at $60, and I will acquire stock Alibaba at $60 plus premiums that I've collected when I sold the booth. So essentially, my price.
As long as the stock doesn't go up too much, in which case, I would bring up one point, which is, I wanted to own a little more MPLX, and I didn't.
So do I.
Cash, I know.
At the right price, by the way.
So I sold the put and I bought the call too, as a way to, put in no cash. Basically, I actually walked away from cash, and because of that, I had the, now in a year, I'll take a little more MPLX. So it's another way to do it if you're concerned about what if the stock goes up, but you'll make money your way either way, because if you sold the put and the stock goes through the put, at least you made a lot of money. So you win either way, Sasha, I guess, that way.
Well,
if you want to own
in
the
this
stock.
case, you will make less money than if you would purchase stock right away. I agree with you.
Right.
But uh, in a way, it's still very profitable transaction.
No, that's what I'm saying.
If
You're
you will
making a
go
lot of
and
money.
figure out annualized return on the positions that you sold, I'm
Right.
talking about puts, it's a great transaction. The only thing you would regret that you sold only
Yeah,
10
no, it makes
puts
sense to
instead of
me.
20 puts.
Yeah,
Or
you win either way, whether you know.
absolutely.
Yeah, absolutely.
MPLX, Peter, to me is just a 9% money market account.
Oh yeah.
In other words, the thing is, if you said,
That's my biggest position, as you
yeah,
know,
well,
I have about 20% in
yeah,
it, but I cover protect
because
them with options, by the way.
you're in a money market account that pays 9%. There are no money market accounts that pay
Yeah.
9%, but
Well,
MPLX is
the
one.
pipelines are
The
it's an
pipeline can just
amazing
run with it.
sector because I
I,
think it has the
yeah,
safety of a utility.
right,
Now there's no danger of, the Biden administration closing down natural
correct,
exports of
right,
gas. So I
right,
like natural gas pipelines. And I'll use that as a bridge to the dividend stock of the day, which is I've been talking about pipelines and oil and energy for 2, 3 months as my pick of the day. So I decided today I'll go with
longer.
another one. But I will say that I dropped CEQP, which was one of my MLPs, because I'd rather have MPLX or EPD or some of the others I've talked about. Um, and because of that, I was reading that they are in the Permian Basin. They have very big exposure. And that's one of I think it's the largest, but it's a huge source of oil and gas for the country. But they have excess pipeline capacity over there now. So they have more pipelines than the production. Now, the production will probably rise to meet that eventually. But I'm going, why take that risk when I, like some of the others? So I did drop CEQP, a former recommendation at basically break even. So for a change, I will go with, what are the other stocks? I went with this week, my dividend pick is BRT, and that is an apartment REIT. Now I'm only 2/3%, but it's the only apartment REIT I have left. I've parted my positions from 60 down to about 18 right now because I'm very cautious about the market for the reasons I talked about in the beginning of the show. The news is, I just don't see a lot of good news. I see mostly bad news, bad news, bad news, and more bad news, and a lot of bad news coming, unfortunately, for the markets, I think, in the short run. But BRT, so it's only 2/3%. It's a small apartment REIT. It's 422 billion, which is actually under the size a lot of the big boys like to even look at. So it's under owned by institutions because of that. But it's not that small. It has 40 properties, 11,300 units. And I like this strategy. It's primarily in the Sun Belt. A lot of Florida, Georgia, North Carolina, Texas, the South. These are large population growth areas. So even if the economy doesn't do well, these areas may do very well. It has a 4% yield, which is very, very good for an apartment REIT. As an example, CPT, which I sold, had a 2% yield roughly, and a lot of the others have lower ones. All their ratios are excellent compared to other REITs I see. Again, I won't own it too much because it's smaller. I'll answer your question in a minute. The price to cash flow is 7.9, according to TD Ameritrade. So that's like a 12.7% cash flow yield. So they can not only cover their yield easily, but they have room to expand or increase the dividend. They increased their dividend 5.1% this year, which, isn't great, their dividend increase history, but, it's nice on a 4% yield. Their debt to assets is average from apartment REIT. So I think it's just an underexposed, good strategy. Again, small, so I wouldn't own too much. But again, trying to get away from energy because it's been tough. And and also I will mention that bonds now have dropped. I caught it almost exactly at the high. It was locking in 3.2 on tax free and 3.2 on treasuries. So we'll see where bonds go. But anyway, BRT is my pick of the week. Did you have a question,
Thank you,
Mo?
Peter.
Did I
Milan,
have a
what about
question?
you?
Did,
What you recommend?
Peter, did you ask me if I had a question?
Yeah, I thought you wanted to say something.
Sure.
Yeah. All of you here are talking about picking individual stocks. Peter and Nick, I'd like to ask you, what percentage of investors equal the market? Do you have any idea?
Okay, well, the thing is, there's actually a study that's done by Dalber.
Right,
If you read the Dalber study, that
right.
the average individual investor will not beat the market, and they'll lose relative to just a index fund, an S&P 500. So most of them will lose. Even Warren Buffett had the great bet.
All right.
Warren
That's right.
Buffett said five million if you can beat the S&P 500 over a
Right.
period of 5 years. No one
Uh-huh.
that, no professional investor. So why are our crazies here
Yeah.
saying we're better than the professional investors?
Well,
Now,
I'll tell you why.
well, yeah. Well, see, I have my reasons working in the market for 38 years with the professional investors that most of them, frankly, aren't that good. Milan. I mean, they really aren't. It's like chess players, as Sasha knows. They're the grandmasters, the masters, and everybody else. And the thing is, everybody else, frankly, aren't that good. And it's the same thing.
Yeah, and I'd like to say this is what this show is about. I mean,
Yeah.
Sasha's option strategies and dividend strategies, and my dividend strategies, I think we outperform the market handily.
Well,
I think I especially outperform the market on a risk-adjusted basis.
I'm so glad to hear you say, I think we outperform the market. That's not a difficult thing to find out now.
Yeah.
I'm not going to talk about my success.
Well, right now, I have outperformed the market, Milan. I have.
Okay, I have outperformed the market.
I have
over the last
definitely.
10 years.
In other words, I can
Sasha has definitely outperformed the
I've
market.
definitely outperformed it. But it's kind of easy when the market is so stupid and the S&P collapsed 20%. So whenever it collapses on any given year, I can outperform it. By the way, I've done studies for our since we manage like 300 to 500 million in pension funds. I've done studies on any given 10 years that our stupid index annuity will outperform the market over a 10-year spread, depending when you start and when you end. So it really depends on, I hate to say it, timing is important. When did you get in and when did you get out? It makes all the difference.
But
I would say that
mention something that Milan never said, that it's 100% that S&P will outperform all the market.
Not on any
not
time
100%.
no, but
It's
that's what our show is about,
95
Sasha.
maybe, but not 100. So
Sasha, that's what our show is about. You've had a lot of success with option selling, and in options, I've had a lot of success with dividend trading over just about any time frame. I mean, I could point to the last 6 months when the market's down 20% and my portfolio is even. But I could look at a lot of other time frames too. I could look at 10 years. I could look at 20 years.
Sure, you got to
I've
look
been
at the time
investing
frame.
all my life. Nick can do that.
Mhm.
You can do that, Sasha. That's what the show's about. So it's an
Yeah,
advertisement for the
exactly.
show. For those people who want to take the time to, now not everybody wants to watch the show and do it, but you have investments.
Peter, but this
ratings
is the
are
reason,
increasing.
Peter, this is the reason why hundreds, thousands of people are watching our show, because they are listening to cream of the cream of North American investing. If they will listen and do exactly what we suggest, they will do very well financially. If they want to go into cryptocurrencies, they want to do a lot of fun GameStop and other.
Or Tesla, which we didn't recommend, was trading at $1,000.
I'm not specialist in that, and I cannot provide.
Why would an investor like Warren Buffett, one of the greatest investors in history, decide for his estate to have it invested in an index fund, mostly in an index fund?
Warren Buffett has not always been the best investor in history.
I was about to raise that.
Okay, yeah. In other words, if you studied him for last, I don't know, it was last 10 or 15 years, he's actually been pretty poor. But what he did, just like Kathy Wood did at ARK, he hits a bump, just like what Peter Lynch did at Merrill Lynch. It was at Fidelity Magellan. They hit a bump, okay? And Kathy Wood is probably the best example of a person who hit a bump. Now all of a sudden gets a reputation. She's this great, wonderful investor.
Oh, no, Nick. It's more than that. But you see, his portfolio over certain periods didn't even outperform the S&P 500.
You're talking about Warren Buffett.
But the thing is, he has access to all kind of deals. He'll take over a company like Geico, and it's a different deal for him, because he'll take over a company, he'll fix it. He bought some great companies where he buys the whole company and he changes it. Right. But his general management over certain periods actually underperformed the S&P 500, and so that was an argument for the index funds. But in any case, we are running out of time, Sasha. It's 1:39, and
okay.
We'll have to beat up on more.
Thank you so much, everybody, for a great discussion. I think next week will bring us even more news. They're, of course, all tied up to what's happening in Europe, especially in Ukraine. We are all affected by that.
Yeah.
And Peter, what you mentioned at the beginning of the show, a lot of people have to start minding their everyday life as we are at war. We are not officially at war, but there is a war underneath. And if the gas prices will reach 15 or maybe even $20, it's worse than a war. I'll tell you that.
Yeah, it could be.
Okay. So thank you so much for participation. We'll discuss everything next Wednesday. I hope that our listeners will provide us with their feedback and questions that they would like us to help them with, whether it's a market or individual stock. Good luck. Have a great week of trading. Thank you very much. Bye bye, everybody.
Thank you.